Welcome back to the session on accounting concepts. So now let us continue with the next concept, that is dual aspect concept. Dual, when we say, the term means, that is to mean two. So when we say dual aspect concept, it is to mean two aspects of one transaction. Say for example, if we have to buy something, there should be a person called seller to sell particular product. Say for, let us suppose we want to purchase fruits, so we are buyer, but if there is no seller, how can a buyer buy something? So there should be a person called seller who is ready to sell the fruits, so only then we can buy. So that means for one transaction we require two parties, and similarly one transaction will have two accounts, and every account will have a debit and a credit aspect. So it is because of this concept we have the, that is the accounting equation also, plus the aspect of debit and credit. So let us see what the dual aspect concept has to say. So very clearly given in the meaning, business transaction always results in receiving of some benefit of some value and giving of some other benefit of equal value. Say for example, I purchase 1 kg of apple and I have to pay the price equal to 1 kg of apple. If I'm going to pay something less, the seller will definitely not give me apples, and if I'm going to pay something more, the seller will be definitely be happy because he is receiving more money and some more profit, which we will never do. So that is why when it is dual aspect concept, or generally what happens is, there is some amount or there is something which we need and we have to pay something for that. So we receive some benefit of a particular value and we pay something for that, for receiving that benefit. A record is made of the dual or two aspects of each transaction. So as I mentioned earlier, there will be a seller and there will be a buyer. So a record of the two aspects, what is being sold and what is the value for which it is being sold, will be recorded in the books of the seller, and similarly in the books of buyer, what is being purchased and for what value is also being recorded. So this is what it means with the dual aspect or the two aspects of a particular transaction. It is because of this particular concept it gives rise to the accounting equation, which is clearly given on the screen. Assets is equal to liabilities plus proprietor's capital. The assets are nothing but all those resources which are owned by the firm, which should be equal to the liabilities. The liabilities is all the money which has been borrowed in the form of loan, in the form of credit taken from the creditors, plus the capital which has been borrowed by the business from the owner. So this is the accounting equation given. Now why it is like that? Assets should be equal to the liabilities, because in case in any time if the proprietor or if the owner is not able to pay the money, he doesn't have money, then at such a time the assets of the concern should be such that it will be able to repay the money which has been borrowed by the owner. So that is why assets is equal to liabilities plus proprietor's capital. This is the accounting equation which has to be kept in mind. The next very important concept is accounting period concept. It is because of this concept we have accounting year, or what we otherwise know it as financial year, which begins on 1st April of every year and ends on 31st March of next year. So why does this concept come? Say I start a business today in 2020 and Say after 10 years, I want to know whether I made a profit or loss in the business. So 10 years from here will be the year 2030 or 2030. So is it possible for me to find out whether I made profit or loss? Definitely not. 10-year time period is very long. The value of money changes, the value of assets changes, the liabilities also change. What asset we have today in the beginning of the business, we may not have it in the end and after 10 years, or what assets we will be having then, we may not have it now. So it is not possible to find out whether we have made profit or loss at the end of 10 or 20 or 30 years. So for this purpose, this concept is being taken. That is, we divide the time period in such a manner we are able to identify whether we have made any profit or loss in the business. And it is because of this time accounting period concept we all have the convenient time period of accounting year, 1 year, which is equal to 12 months. So let us see the definition, the meaning here. The business or working life of an undertaking is split into convenient short periods of time called the accounting periods. So 1 year is regarded as the ideal accounting period. So 1 year, that is 12 months time, is always considered that is the best time. So we can as we maintain the books of accounts, we record the transactions, it is possible for us to hire the services of a chartered accountant and summarize those accounts and get the income statement prepared and the balance sheet. Income statement will tell us whether we have made profit or whether we have made loss, and the balance sheet will tell us our financial position. So it is because of this concept we are able to prepare the profit and loss statement and try to identify whether we have made a profit or loss. The next concept is objective evidence concept. So what it says is simple. All accounting entries should be evidenced and supported by source documents or business documents such as invoices, vouchers, etc. Say for example, whatever is the transaction that is happening. Say I may purchase a fixed asset like land or a building or machinery. I may purchase say current assets like stock, goods, raw materials for making the product. So let us take, if I take the example of chips, potato chips, then I have to purchase potatoes. If I am making some sweets or any confectionery or eatable, then I need to purchase the wheat, atta, or the different kinds of flour, sugar and other things. So all these will be raw materials. So whatever I purchase, it should have some evidence, some proof, what we otherwise call in our layman's language proof, that I have purchased this particular kind of asset or something, any other related aspect. Or even in the case of income, so when I'm earning certain income, there should be a proof that I have earned that income. So that should be supported by invoices. Invoices, otherwise we call it as bills, right? Whenever you go to shop, we insist that you purchase, when you're purchasing something, take a bill of it, so that in case if the goods are faulty or defective, we can show with evidence when we had purchased, and we can get a replacement or the refund for the same. So objective evidence concept says that whatever you do, whatever transaction is being taking place, it should have sufficient, that is records with you to prove that these transactions have taken place. When you do not have records, what happens? It becomes the that is disproportionate assets case, which we generally see, which leads to accounting frauds. So the next concept is revenue recognition concept, the most important concept in accounts. At what point you are going to identify that the revenue is being made? So it is at that point when the goods or services are transferred to a customer and the customer becomes legally liable to pay for them. So I have purchased, that is sent some goods to the customer. So when the goods reaches the doors of the customer becomes liable to pay for the money for the goods so sent. So it is only if I give the goods, then only he will make a payment. So that is the point of identifying from where the revenue generates. If I do not send the goods at all, I cannot hold my customer responsible to make the payment for the goods. So revenue recognition concept mainly deals to identify the point of time where the customer becomes liable to pay the money, and the customer becomes liable only when the goods have been sent to him and he has received the same. So this is revenue recognition concept. The next concept is accrual concept, based on which we prepare our accounts. So what is accrual concept? So it means that when a transaction has been entered into, its consequences will certainly follow. So for example, when we enter into a contract, so today what do we do? We sign today. So because we have signed and we have agreed for something, tomorrow one person will manufacture a product and send to the other. Because the goods are received, the purchaser has to make the payment. So it goes on. So because of one particular act, there is a series of activities happening. So that is what is meant with accrual concept. One transaction, when a transaction has been entered, there is a consequence which follows. So when let us take the same example what I said. First, there is a contract which happens. Based on the contract, the person will manufacture and send the product. The seller will do the manufacture and sell the product. The buyer will purchase product and give money. Suppose if the buyer doesn't give money, what will happen? Then it will become a bad debt. Or what will happen? The seller has to go in search of the buyer to recover the money. So all these are a series of activities just because of a contract which has been signed by the buyer and the seller. So that is what is meant by accrual concept. And in this accrual concept, the following, that is outstanding incomes, outstanding expenses, income earned but not received, will be included. So here, that is O bar S is the short form or abbreviation to write the word outstanding. So outstanding income means the income which you are supposed to receive but you have not received. And outstanding expenses, the expense which you should have paid but you have not paid. Say for example, let me take the example of a rent. A shop which you have been running the business and you have to pay rent to the owner. So from your perspective, it is an expense. Because you are running a business, you have to pay the rent. So it is an expense. So when you should have paid? At the end of the month, that is 30th or 31st of the month. But when do you actually pay? You may pay it on 1st of the next month, or maybe the first week of the next month. So what will happen on 30th or 31st of the month? It becomes outstanding expense. That is, expense is due. You have to pay, but what has actually happened? You have not paid. You are paying it in the first week of that is next month. Same way, from the owner's point of view, the rent is his income, and for him what will happen? On 30th or 31st of the month, it is income but not received. So it becomes outstanding income. and only when the money is received in the first week of the next month, then only it becomes income received. So outstanding income is to mean the income which has not been, that is, received. Income earned but not received. So that is what is meant with accrual concept. The last concept, that is matching concept. So matching concept is the result of matching the income with the expenses. So profit is the result of two factors, namely the revenues and expenses. The resultant balance is taken as the net profit or net loss. So income minus expense, if it gives profit, it is good, and if it gives loss, that means expense is more, income is less. So at such a time it will result to loss. So what actually happens is, to make this per sale, what all expenses I have incurred. Say, let us suppose I am manufacturing some sweets and I sell it. Now to sell those sweets, what expenses do I make? Say I may have a small bakery. So for that bakery, I have to invest in the form of those glass good looking shelves. I have to invest in the form of furniture. I have to invest in the form of an oven to heat all those baked products, or maybe the stove and other things where I need to, that is, fry or do whatever of these sweets, right? So, and I have to pay the rent, I have to pay the electricity bill, I have to advertise so that customers know that such and such bakery is there and such sweets or whatever are being manufactured. So just to sell the sweets which I have manufactured, I am incurring so much of expense. I'm paying the rent, I'm paying the electricity bill, I'm making advertisement, I purchase the raw material like the sugar and flour and other things, and I convert them, I make it into finished product and sell. So these expenses are incurred for the purpose of sale of the sweets. So that is what is called as matching concept. For the purpose of sale of the sweets, whatever expenses have been incurred are matched, and I try to identify whether I made a profit. That is, the money which I get by selling sweets, if it is more than the expense, then it is profit. But in case if the expense is incurred is more and the sales which I am getting from the sweets is less, then it is loss. So this is the main essence of matching concept. With accounting conventions, I shall continue in my next session. Thank you.